I'm Charlotte McLeod with investingnews.com, and here today with me is Lobo Tiggre, editor and founder at independentspeculator.com. Thanks so much for being here.
Always happy to be with you, Charlotte.
Oh, great. Really nice to see you. And we're here at the New Orleans Investment Conference. I have a whole bunch of questions for you, but then you told me that in your talk today, you were giving your highest conviction trade investment for 2024. I'm not sure if I'm getting the wording right, but it's not the same as 2023. So I have to throw these out the window for a minute, and because I just need to know.
It's a good place to start. So we're scooping here, live from New Orleans, or almost live, right?
Almost.
Okay, so this is a mining and investment conference, but really most of us are gold bugs here. This is the one thing that's near and dear to all our hearts. So last year I was the contrarian in that my highest conviction trade for 2023 was the other yellow metal, uranium, which is not a stranger to your audience, right? But, to come to a gold bug conference and talk about uranium is my highest conviction trade was fun. So I want to be careful about what I'm saying here. I'm not saying I'm done with uranium. I'm not saying I've sold all my uranium stocks. Though, like Rick Rule, I've taken a lot of profits along the way here. But it's no longer the hated trade, that was on sale. Nobody wanted to hear about uranium anymore. A lot of these uranium stocks are now at multi-year highs or nearly there. So still bullish on uranium, still very positive. The demand case is very, very strong. But the stocks are no longer as cheap as they were. And a lot of the mothballed production, the part of the supply story that has been under voluntary constraint, that's starting to change. So for 2024, which is different from farther going forward, we need to see how the balance works out. Farther ahead, I don't think supply keeps up. I'm totally sold on uranium going forward. But for this coming year, it's no longer my highest conviction trade. So that actually leaves us with the other yellow metal. Gold Bug Conference, big surprise. I like gold. But, for what it's worth, I'm not a perma-bull. Last year, I came here and I talked about uranium as being my highest conviction trade. And even worse, more traitorous of me, this summer I put out a bearish call on uranium. I don't remember if we talked about that. We did?
Yes,
okay.
we did.
So our audience knows that I'm not a perma-bull. So maybe it means a little bit more for me to say, no, I'm looking at it, looking at the recession. It's here on a global level, and I think it's here in disguise in the U.S., but I think the disguise falls. We've talked about that. I only have a couple months left to be right on my call about recession by the end of this year. But even if I'm wrong and it slides into the next quarter, I still think it's coming. I think the recession denial goes away. And I think that's very, very bullish for gold. And on top of that, you still have the central bank buying. We have geopolitical stuff stirring the pot. So there's a lot of things that, and inflation isn't going away. Its expectations are starting to slip. The Team Soft Landing kind of swept that under the rug from the last PCE report. But the near-term and long-term inflation expectations started to creep up, which is quite significant. So all of that is, a way of saying, nothing, gobsmackingly new here for the audience. They probably know all this stuff. But again, for what it's worth, I'm not a perma-bull, but my highest conviction trade for 2024 is gold stocks. Oh, and one other thing. Remember what I said about the uranium stocks? Many of them are at 52-week highs or nearly there, or even multi-year highs. Not so with the gold stocks. Because of higher costs and all these things, a lot of them are on this. That doesn't mean you can go out and buy them all. But what I'm saying is there's value on the table. There are compelling value propositions, many stocks that are just producers that are cash cows or mine builders that have all the money to build their mine. They're going, right? And they're on sale at 52-week lows or nearly there. So the value proposition, I think, is really quite compelling in a number of these gold stocks if you can pick the right ones.
Okay, and just to clarify, so the highest conviction trade for 2024, it's gold stocks, not gold itself?
Well, yeah, and that's actually an important distinction. This, again, is not new. This is something my mentor, Doug Casey, taught me from the beginning. To my way of thinking, gold is not a speculation at all. I don't buy gold because I think the gold-dollar exchange ratio will go up or down or whatever. I buy gold because it's gold. I can hold it in my hand. It has value. If I need it in case of emergency or opportunity, it's there. It's physical wealth in my direct control. It has nothing to do with where the dollar's going or the Fed or the markets or anything like that. It is what it is. As a speculator, though, if I do think the gold-dollar exchange ratio is likely to go up or down, you could go long or short, then the stocks are the way to make money on those movements. I don't trade gold at all. It's my way of saving. It is literally how I've saved for the long term. And I don't buy 30-year bonds or none of that nonsense. I save in gold.
Okay, and I'm going to bite on your comment that was, if you can choose the right gold stocks, right? And I think that people, hopefully, if they've been following you, they'll know kind of your principles behind how to choose the right stocks. But maybe there are points that we could talk about that are specific to this current environment where gold stocks are quite depressed.
Sure. Definitely one size doesn't fit all. And, the more risk-averse people should probably look at the bigger go-to names in the space and all that. That having been said, though, even if you're more, have a higher risk appetite, when even the go-to names are relatively on sale because the whole sector is hated, then even they can offer, the bigger players can offer junior-like volatility to the upside if you can get them near cyclical lows. Now, most of the big ones are not really at cyclical lows, but they're cheaper than they have been, and there is opportunity there. The farther down the food chain you go, the more risk you go there, and so that depends on who you are. And then besides just that, there's also your time frame. And this isn't new. I'm not telling you something other people haven't told you, but it really matters. So if you have the patience of a Rick Rule or somebody like that to buy something and wait whatever number of years, then, even pre-discovery exploration on a basket, say, of prospect generators, you never know which one's going to hit. But if you have more than one, a basket of them, and you have patience, you pick the ones that have good management, they have money from partners coming in, they're not just prospect generator wannabes, but they're doing it, right? They're following the business model. They have other people's money going into the ground on their behalf, that sort of thing. You never know which one of those is going to be the next discovery, but it happens, right? Periodically, these guys deliver amazing discoveries paid for with other people's money, and those can deliver terrific hockey stick wins. But you got to be patient. You can't say, oh, I want a prospect generator to deliver this year for me. Right? It just doesn't work that way. And in between, there's other things. That I like the pre-production sweet spot. It's my claim to fame in this space, right? I like first-time mine builders. It's the most reliable pattern I've found, not really for 10-baggers very often, but for significant gains with relatively low risk. And in between discovery and development, there's also something I call success in progress, which I think we talked about before. And then it's after the discovery fall. It's like people have this idea of once the discovery is done, well, then it's off to engineering and feasibility studies. And it's not like that. It takes years even to define the deposit. You make the discovery, and now we have to drill it off. How big is it? You never know. And in that process, going from an exciting drill hole to having a deposit of measurable size and potentially value, there's a lot of value added. And that's an area where, again, nothing's perfect. It is speculation, but you can put the odds in your favor.
Okay, so definitely time frame matters, but I know over at least the past year, perhaps longer, I'm not sure, your theme has been sectors that are happening right now. So I imagine that gold is going to become a now sector in 2024. I've been debating in my head if I should try to ask you where you think the price is going to go. I'm going to throw it out there and see what we get.
It doesn't hurt to ask. Yes, I don't like making predictions. I think the trend is upward, and I have said before, I'm on the record having said that I think the chances are good that we would see new all-time highs this year. And I have a couple months left to be right or wrong. And I don't want to be right because of the war. That would be a sad reason to be right, but it could be. But hopefully that doesn't happen. I would rather be wrong than to see more dead bodies over there. I much rather see myself be right because the Fed breaks something. Again, not because I want to see economic harm. I'm not lobbying for that. But actually, I think the Fed breaking something, it's already baked in the cake. It's just a matter of where does the shoe drop. And we'll see. That gilts excitement that we had over in the UK, year before. Nobody saw that coming. It was the sort of thing that once it happened, everybody's like, of course, that makes sense. Rates go up, this would happen. We'll see. But even if I'm wrong, I missed the timing. I still think we'll see it early 2024. If I'm completely wrong and Team Soft Landing is right for the first time in history, then I'll be wrong and I'll change my marching orders.
Right. And maybe tell me more about the recession in disguise that you mentioned earlier. What are you seeing that is disguised as a recession?
Okay. Well, first, I mentioned the leading economic indicators. They're called that for a reason. And the main thing that the Team Soft Landing folks point to is the strong consumer and labor market. Those are lagging indicators. And they'll even say so, even on mainstream, on Bloomberg or Yahoo Finance, are these people who love to talk about NVIDIA and Chipotle and all these fashionable names, right? No gold stocks for us, thank you very much. Even those guys will say, well, yes, labor is a lagging indicator. And then they just go right on to talk about how strong it is. Like they mention it in passing, and then there's no so what. There's no follow-up to that idea. But it's there. My thesis is that in the post-COVID lockdown period, you have this phenomenon of labor hoarding. You have companies that had such trouble finding employees. And even now, with the so-called excess saving, keeping people off the labor market. Right? So it's hard to find good people. And that makes employers really reluctant to let anybody go. But think about that. If your business is in trouble, but you don't want to let people go because you're afraid you won't get them back, that means, I'm sorry, but the economics of it is you're making a bad decision. You are increasing your cost. Like, you don't need these people. You should fire them, but you don't because you're afraid and you can't get them back. And then when you do run into trouble, you've made it worse. Like, you've exacerbated the problem. You've made your financial difficulties worse because you didn't do what was necessary. You didn't cauterize the wound when you had the chance. So I'll either be right or I'll be wrong in fairly short order, Charlotte. We'll see. I think that, even on mainstream, you hear people talk about rolling recession or recession in some areas of the economy, but not others. I don't think it's that at all. I think we're seeing post-COVID distortions hiding a far deeper weakness in the economy. And it's not just the leading indicators. It's things happening now. Like, there are more bankruptcies so far this year to date, than since the GFC. And that's huge. And you have federal revenues plummeting. Remember the big surprise on the budget deficit? Federal revenues plummeting are another very strong correlate with recessions. And then there's the big layoffs we hear about. And look at the earnings calls. These companies are beating on earnings, but that's after they lower their guidance. And the forward-looking statements that we're getting, there's, if not grim, they're cautious. So I think I'm not out there really just a lone wolf in the night howling and saying something nobody else is seeing. I think there's all this evidence out there that the people with a certain mindset, they're just, I'm not listening. And I think we'll find out soon who's right.
Okay, and we should probably throw the Fed into the mix as well, because I imagine if things...
Just throw them out.
Not in this conversation. They're going to be part of it, unfortunately. But I imagine if things play out as you are saying, it's at this point where we see the Fed say, okay, I need to start cutting rates. Is that kind of how you see it?
So it's funny. You have more mainstream types like, say, Jeff Gundlach, the bond king, talking about how the Fed is going to start cutting in 2024. And if you look at the market odds, the market thinks the Fed will be cutting by mid-2024. But the thesis behind that version of the rate cut is, the Fed's won. Inflation is tamed, and now we don't need these high rates. Higher for longer doesn't have to be so long because soft landing, right? That's not my thesis. My thesis is the Fed is breaking something now. We're just waiting to find out what it is, right? Is it commercial real estate? Is the student loan repayments that blows things up, or what? We don't know. But in hindsight, it'll be obvious, I think. And so that's my thesis. It's not the mainstream thesis of happy ending. It's something blows up, and then we have to for financial stability. But my question, though, and this matters for gold bugs, is who's going to pivot first? Because the Fed paused, ECB paused, the BOE paused again. The Western central banks, they seem to be all following the same thing. And it matters because, Germany just reported negative growth. Did the EU as a whole, the recession there is becoming harder to ignore. And it's not official, but it's close. It's borderline, right? And so if they pivot first, then that's bearish the euro and bullish the dollar. The dollar wrecking ball comes back, right? And that's bearish for gold again. Whereas if there's a surprise in the United States and suddenly the Fed slams on the brakes and does a U-turn, well, then that's bearish for the dollar, bullish for the euro and gold and other alternatives to the dollar. And I don't know how it's going to go, and I wouldn't believe anybody who said they will. But all of these things are in play right now, and it will be an interesting time for speculators.
Okay. One follow-up question there. If somebody else cuts first, not the U.S., can that prolong strength in the U.S. for some other period?
Well, it doesn't make not strengthen the U.S., strengthen the dollar. And an important caveat there is, we call this the strong dollar, but it's only strong compared to the other currencies. It's not like the dollar is actually becoming more valuable. It's just losing the race to the bottom, right? So I don't want to say transitory, but I do think there can be a brief period where it seems like the dollar wrecking ball's back, dollar's fine, everything else is, and I think that creates a buying opportunity. I know people don't want a buying opportunity. They just want gold to go to the moon already. But we don't get to tell Mr. Market what to do. So I'm just calling it like I see it. I do think, in the same way I said last summer, that this, I made a bearish call. I'm not quite making a bearish call here because the war, for instance, could keep gold elevated in spite of all this. And I don't know that the ECB will necessarily pivot first. My suspicion is that unless something obvious breaks soon here in the U.S., probably the ECB will pivot first. Not a prediction, I don't know, but my gut is sort of inclined in that direction. So it matters in the near term. But going into 2024, doesn't matter. Global recession, including the United States, very bullish for gold and the gold stocks.
Yes, and the gold stocks. Did we miss any factors to do with gold that you would think investors should highlight? I guess we didn't really go into central bank demand, which is quite strong.
But it's one of those things that it's on a moment-to-moment basis, it's unknowable. You only know about it after the fact. And you get to, like right now, we just had new figures from the World Gold Council, record buying level but you know about it afterwards. And even if we have a record year, that doesn't tell you that this month that they're going to be buying, right? They can take a breather, or they can even sell some because they have, like Turkey or some of these other countries that have been overall over the years amassing. Suddenly they need some money. That's what savings are for, right? So I'm persuaded actually that the central bank gold buying driver for this story, it's important, it's long-term, it's part of the long-term de-dollarization trend, which with all due respect to our friend Brent Johnson, that's a real thing, long-term. But it doesn't tell us what's happening now. Happening now, my theme.
Now, okay, so we will move over to uranium, but I'm going to ask you first about silver, staying on this precious theme, because you told me you have updates to your Darth silver thesis, and I'm a little bit worried about this, but we got to ask.
Will the Darth silver mask fall off? Well, no, not entirely. I'm not saying that. What I am saying is that over the last year, and you and I have talked about this, and our audience, if they've listened to us before, they know that I've said, I love silver. I understand silver is the word for money in many languages, but just look at it. It often trades more like copper than gold over the last year. You'll see that, in the intraday charts. You'll see days where gold goes up and copper and silver go down. Or you'll see days where gold goes down and copper and silver and oil will go up, right? It's acting like an industrial metal. And it does have that industrial use, which is, in some ways, it's great. It's on top of the monetary story. You have this increasing industrial demand. It's an energy metal. You need it for the solar panels. Nothing bad with that. It's all good. But it does mean that if you're looking at industrial metals headwinds, if you're looking at a recession, then that tailwind for silver turns into a headwind. And you can't ignore that just because silver is money, right? So that's been my Darth silver thesis. And the new news, we're getting it here, New Orleans, is that we really saw silver come out strong as a safe haven, as a monetary metal. It reacted strongly to the war news like gold, not like copper. So we've seen in recent weeks a a strong reminder that the world does still see silver in this other way, not just as an industrial metal. So it was an open question. Is silver just becoming an industrial metal now? And the latest market action is saying, no, we're not there yet. Silver is still being treated by, not just those evil Darth types of the world, but even comics traders are willing to move the price of silver based on monetary phenomenon, safe haven phenomenon, not just industrial demand. So that's great. That's good to see. It makes me much more optimistic about silver tracking gold in the recession ahead. But I still, call me Darth all you like, but I still think it will probably underperform. If the main reason that gold is going up in 2024 is the recession, at the very least, it takes away that tailwind that silver had. So, be cautious.
Right. Okay. One small follow-up on silver. So silver, I think I'm learning it needs to have many things working in its favor. And, I was talking about somebody today, I don't remember who at the moment, about the big deficit in silver last year and the predicted also large deficit this year. But that's only part of the equation, right? I guess, just trying to understand how that works.
Well, I tend to get less worked up about these things. People get all excited about how much silver is left in the comics warehouses or whatever, or the LME. But first, remember that silver is consumed in a way that gold isn't. It is literally consumed. It is put into things like eating it, electronics that you can't get it back out of, and it goes into the landfill when it's done. And, it's like become a new mine in the future. It's used up. So the stocks are always lower than gold, and they're always fluctuating. They go up and down, but it's also produced in much larger volumes. And then that brings us to the other main thing to remember is it's a byproduct. Like even the purest silver mine in the world, it's not metallic silver that they're mining. The highest grade silver mines in the world are really lead or lead zinc mines with huge silver credits. Even if it's kilos per ton of silver, it's kilos per ton of silver in galena or sphalerite, these sulfides of base metals. But even that isn't, the single largest source, as I recall from the latest numbers I've seen. People combine lead and zinc, and that makes it look like the largest source. But if you look at just lead or just zinc, copper is actually bigger. These big copper porphyries, these giant copper mines, very low-grade silver in there, but they're so huge that they produce enormous amounts of silver. So that's another complicating factor. And I'm not being anti-silver here. This can actually be a very good thing for silver, particularly if what's moving gold and silver is safe haven demand, monetary metal demand. Well, that means the economy is not looking so good. And that's the sort of thing that shuts copper mines down. So you can have a situation, this is when silver really shines. You talked about factors coming together. The perfect storm for silver is when people are buying it because they're worried. Safe haven demand is pushing gold and silver up. And that very same thing is shutting down industrial metals mines, zinc mines, lead mines, and especially copper mines. Those go on care and maintenance. Supply is visibly constrained at a time that demand goes up. And that's when you see these little manias where silver just leaves gold in the dust and it goes nuts all by itself. That's not a prediction for 2024, but it could be. The cards are in the deck in front of us that it could play out that way.
Okay, we'll be checking in. We'll be checking in, and we'll see how that develops. So moving on to uranium. So as you said, it doesn't mean uranium is out of favor with you, but we're in kind of a new phase of what's going on here. So we have this recent price rise that everybody's pretty excited about. And I thought maybe we could start there and just ask you, what do you think spurred that uptick there? Is it one single factor? Is it just everything is now working out? What is happening?
Nothing is ever just one single factor. But my view is that it's largely people coming to the realization that, yes, the utilities do have to get more uranium now. There's only so much they can get from the existing fuel chain and underfeeding and all this stuff. Frankly, Justin Hune at Uranium Insider could explain the ins and outs of the fuel cycle better than I ever could. But at the endpoints, right, you've got the miners and you've got the utilities, and they do sit down and contract over the long term. They need security of supply. It's a real thing, and they are starting to sit down now. We're seeing the producers or the near producers are reporting that they're signing contracts So this is something that I have said is what we needed to see in past years when we've spoken about this. So this is happening now. It's not just inevitable. It's not just imminent. This is happening now. It's being reported now. We won't know what the prices are. They say very vague things like at competitive market prices or whatever. We'll find out in retrospect. But we know it's happening now. We also have Japanese restarts, Rick Will's favorite variable. That's happening too. You'll never know exactly what the impact is until later. But clearly it's happening now. And this is actually something else that I've been writing about recently, because there's metals and mining investors, our audience, they're more savvy than the broader world out there. But in the broader investment world, yeah, I'm buttering you up, but it's true. In the broader world out there, there's this idea that, the energy sector is like this one monolithic blob. And so if we're going to have a recession, well, that's bearish for energy, right? The energy sector is going to go down. And you will see some knee-jerk responses. And something's bad for energy on a day-to-day basis, you'll see it. It'll hit, the spot price of uranium will wiggle down with oil. But if you plot uranium and oil over time, you see that they frequently move in very different directions. And it just so happens that we've had the war and other things causing oil prices to go up, and then uranium went up at the same time. And so here's the thing, that there's a mainstream narrative to the point that, to the extent that anybody who isn't in the space even notices uranium at all, there's a tendency to want to dismiss it and say, oh, it's just because the energy sector's up. It's because of the war, oil's up, so of course uranium's up. It's not going to last, right? I think that's completely wrong. In the first place, it's totally out of proportion. Oil is up like this and uranium is up like this. And in the second place, over just the last year, you can see multiple instances of them moving in opposite directions. So I think that the current move in both upwards is coincidence. There have been more times when they've moved opposite than in synchrony over just the last year. Anybody can chart these and look at it. So I think something different is going on, right? What we just talked about, the contracts, the restarts, the fuel cycle, now the centrifuges need to start loading them up again, right? And they need pounds for that. So the takeaway is, don't listen to these people who are saying, oh, it's just because of the energy sector, and when we go into recession, it's going to go into reverse. If I'm right, the utilities need these pounds one way or the other. I don't want to say it's recession proof, but far more recession. Like, I really don't think the recession matters that much here. If you need to secure your next 5 years of supply, then you're going to secure that. You don't care whether there's a recession or not. You're securing for the long term.
Okay, so that gives us an idea of what's happening now. I don't know if we've gotten to this point in previous conversations, but we should talk about price trajectory moving forward, because I think people generally in our sector anyway agree we're going on.
Right.
But in what form?
And this is a really good time to ask this question, because in our previous conversations, I've been able to say, and I have said, unlike other metals, uranium's still below the cost of production. The average cost of production, or the incentive price, if you will, even though some copper miners are unhappy with copper back below $4, still $3 and change is enough for most of or at least the better copper mines to make money. And gold, your better miners, if they can't make money at $2,000 gold, there's something wrong with them, right? And, so most of the metals, even having retreated, are at prices where the miners, at least the ones worth owning, can make money. Not so with uranium. Until now. So now, and they're talking about happening now, we are at that point now where uranium at plus or minus $75 a pound, that's the incentive price that we've been given. It's in the mid-range of the incentive price we've been giving, and you can see, the big producers that have mothballed production, they're bringing that back online. The developers that have, the lower cost mines, or even, not the lowest cost ones, they're starting to say, okay, well now $75, we're gonna go into production. So this is happening. Now, I think the last time we talked, I had written my uranium report, and I made a long-term case that supply will not keep up with demand. But so that's out. Yeah. It's free download on the website. Look for our uranium report. So the finding, the news there was that I had been thinking that high prices would cure high prices here. And uranium is not rare. And like we were just saying, right, the mothball production, not even new production, but like mothballed existing production, that's coming back online, and that's happening now. And the lowest cost projects, those are being built. That's happening now. and I don't need to name names. Most everybody knows who's doing it. There's only a few companies doing this. Everybody knows who I'm talking about, right? So I had been thinking actually that I'd end up probably selling most of my uranium stocks like next year as high prices start curing high prices. And the finding in our report, our new report, is actually, no, it doesn't look like it's going to keep up. Like even with this low-hanging fruit coming online, the stuff that can be brought, the pounds, never mind the billion pounds of uranium that are supposed to be out there waiting to flood the market, that's not going to happen for a long time. If, some of those aren't even economic, I don't believe the whole billion uranium pound scare. But there are pounds that are coming on the market now. So what's different is I had thought that would really make uranium prices roll over. I no longer think that. But with those new pounds coming on, it's hard to say that now's the time for uranium to go vertical again, right? So to be very clear, I'm not bearish. I'm not anti-uranium. I'm not saying it's peaked and it's going over. But I'm saying last year it was easy to say, okay, uranium's got to go up. The price is still too low. It's no longer still too low. We're at the incentive price now. So it's harder to say, oh yeah, it has to go up again. Now it may. If the centrifuges need to refill, right, and the companies need to make the long-term contracts, we may still see higher prices. But it's less of a sure thing than a year ago to say, it's got to go. So that's where I'm at.
Okay. Yeah, I have. I read the report and I liked it. Thank you for writing it. Yeah, it was a great report. I'll leave a link to it so people could check it out if they want to. And yeah, that was really what I was picking up there. Kind of the point about, overestimating supply, I guess. And it looks like you're thinking only the mothballed mines and the really true development stage assets are what we should count in our numbers. Is that kind of right?
For right now, for what's happening now. Right? I mean, there's some great projects out there that will probably get built in this cycle, but they're not even permitted, right? So that's going to be a while. So what I'm saying is I see a rush of supply coming back to the market. I don't think it swamps the market. I don't think it floods it and prices tank, but maybe it comes close to meeting it. So near term, the balance of supply and demand is not so compelling for a much higher uranium price. But then once that's digested, especially the mothball production, that's coming online now, and by 2025, once that's digested, once that's priced in, I think there's nowhere to go but higher up. But that doesn't make me want to say, well, it has to go vertical, right? It's going to the moon, right? It's in a market that's going to be in deficit, but not like desperately so for some time. I think it will, by the way. I don't know of anybody's models, supply and demand models, that even includes the SMRs coming online. It's all about the big, the reactors that we already know, the ones that China's planning, the ones that India's building, right? The whole SMR thing, that is still going to take a couple of years to get going. But when it does, that's a whole new layer of demand that's not in anybody's models. And if nothing happened, if the whole thing just fizzled away, it wouldn't take away from the already existing demand increases that we're projecting. So there's nothing but upside here. So longer term, I really am, very bullish, with the one caveat being of a major nuclear accident, right? If that happens, this thesis can be derailed. And I hope it doesn't. I don't think it will. It's one of those things that it's not like a trend you can chart. You can't say, oh, well, they happen every X years, so now we're overdue. It's not like that. I just think it's something that anybody speculating in this space, you really need to understand and accept that as long as this doesn't happen, looking good. But if it happens, you're going to take some lumps.
Okay, I've got one more uranium question, and then we can start wrapping up. So in the report, you also go over kind of this east-west developing divide in uranium, and I wanted to ask you about that, maybe in the context of this recently approved Kazatomprom deal with the Chinese buyer. So thoughts there.
Yeah, this is one of those things where I don't want to make too much of it, and I don't want to dismiss it either. I think it's very important. I think going forward, the new Iron Curtain, or whatever you want to call it, that's a real thing. I think, we can basically expect almost all of Kazatomprom, or all of Kazatomprom's production, it's all going to go to China at some point. But this will take time to develop. It's one of those things where I think it shapes our outlook over time. But today, it doesn't really change my marching orders and my investment decision very much. And the bigger concern I have is really more the geopolitical risk right now. And Kazakhstan is not Russian, but their main shipping route goes through Russia, so there's an issue there. Now, fortunately, even the powers that be in Washington and other such friendly places, reality does matter. And there's been all this talk about sanctions and tough on Russia, and there's even been talk about, banning Russian uranium and enriched uranium, but it hasn't happened yet, because I think at some point, at some level, even these people understand that, like, there is no other source. If they ban Russian enriched uranium, it's not happening. We're not getting it. There's no plan B. And okay, we're working on domestic supply, but that takes years. Even the front runner, they're still working on a pilot plant. So, and you know who I'm talking about, right? So, that's one of those things where if they do something really stupid, if they put a hard ban in and they really put a choker on this, then yeah, you could see $200 uranium. You could see crazy things. And it's not a prediction. It's a possibility that could happen. But so far, it seems like for all the tough talk and all that, they're aware of the reality back there and that they can't go too far. So right now, the trend that I see is basically towards nothing happening on this front. Lots of talk, but nothing happening.
Okay, I think we can wrap it up here. I will ask you your final thoughts, and I've been doing I've been calling it a fun question. We'll see if it's fun. But I've been asking people do's and don'ts for investors heading into the end of the year, perhaps into 2024.
Well, okay, if you frame it end of the year, well, we're going into tax loss season.
Yep.
And this is a very interesting, I would say that given the market sentiment, how bearish it is, if you're looking to harvest tax losses, I'd probably do it early. So in fact, the next edition of my take that comes up this coming Monday, then it's going to be all about tax losses. That's going to be our tax loss edition. We'd probably do a tax loss edition every year, or we'd cover it. But anyway, this will be a tax loss focused. And the idea will be, you probably want to be earlier this year than late. On the flip side, though, if you're looking for bargains, there are companies that have added pounds in the ground or ounces in the ground or done, really good feasibility work, clarifying their value propositions, or come up with a new flow sheet with different processing that has a significantly higher recovery. That's it's a material improvement to this project. There's a number of those. Market just doesn't care. They're still on sale. They're still near 52-week lows or dragging along the floor. Despite, uranium high, gold high, the other ones so. But, due diligence is required. Don't buy an ETF. But if you either know what you're doing or you're willing to get some help, obviously I'd like to help, but if not, somebody else, the Brent Cooks of the world out there's other people who know what they're doing. Get some help, find some good picks. I think that this tax loss season could actually be a spectacular buying opportunity, particularly in the gold space. If I'm right about what's happening in 2024, then this tax loss season could be a gift. And there's a happy thought. I hope that was a fun answer.
That was fun. Thank you. This was a fun interview. Thanks for coming by to talk about my many questions about all the different commodities.
My pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. This is Lobo Tiggre with independentspeculator.com. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.